Imagine finding $12 in your couch cushions every single week. Not a windfall, not a bonus, just $12. Less than 2 fast food meals, less than 1 streaming subscription and a coffee. Now imagine that $12, put in the right place every week, quietly turning into $500,000, without you ever getting a raise, without you ever picking a winning stock, and without you ever needing to check the market obsessively. That's not a hypothetical. That's the dividend snowball method. And it's one of the simplest wealth-building strategies that almost nobody actually sticks with long enough to see it work. In this video, I'm going to show you exactly how Mike, our example investor, turned a $500,000 portfolio using the dividend snowball method. I'll break down what this method actually is. The one mistake that stops most beginners before they even get started. The exact criteria for picking the right stocks. And by the end, I'll walk you through the real year-by-year numbers that take Mike from $12 a week to $500,000. This is a beginner guide, so if you've never invested a dollar in your life, stick around. I'm going to make this as simple as possible. Let's start with the core idea, because once this clicks, everything else in this video makes sense. The dividend snowball method is built on one simple mechanism: reinvesting dividends to buy more shares, which then generate more dividends, which buy even more shares. And I hope snowball a wonderful day. But push it downhill, and with every rotation, it picks up more snow. It gets a little bigger, which means it picks up even more snow on the next rotation, which makes it bigger still. By the time it reaches the bottom of the hill, that tiny starting snowball has become something massive, and almost all of that size came from the rolling itself, not from how big it started. That's dividend investing with reinvestment. Mike starts small, just $12 a week. Some of the companies he invests in pay him a small dividend, usually every 3 months. Instead of taking that dividend as cash and spending it, Mike automatically reinvests it, buying more shares of the same company. Those new shares then earn their own dividends next quarter, which get reinvested too, buying even more shares. Round and round it goes. In year 1, this barely feels like anything is happening. But give it enough years, and the snowball effect takes over completely. Now here's the part that trips up almost every beginner, and it's the reason most people who try this quit before it ever works. They expect to feel progress early on, and when they don't, they assume the strategy isn't working. Here's the truth. For the first 2 to 3 years, this method looks almost embarrassingly slow. Your account barely moves. You're contributing $12 a week, watching your balance creep up by roughly what you put in, and it can feel like the dividends aren't doing anything at all. This is exactly the moment most beginners give up, right before compounding actually kicks in. The dividend snowball doesn't reward you early. It rewards patience, specifically because the real growth doesn't come from your contributions anymore around year 7 or 8. It starts coming from the portfolio itself, growing on its own. So if you remember one thing from this video, remember this. The boring years are not proof the strategy is broken. They're the foundation the entire snowball is built on. Now let's talk about how Mike actually picks the right stocks for this strategy. Because not every dividend-paying company is a good fit for a snowball approach. There are 4 categories Mike looks at. And for a stock to make the cut, it needs to check at least 3 of these 4 boxes. First, blue-chip dividend stocks. These are large, well-established companies with decades of reliable operations. Household names most people recognize immediately. They provide the stable foundation of the portfolio because they've proven they can keep paying dividends through recessions, market crashes, and economic uncertainty. Second, dividend aristocrats. These are companies that have increased their dividend payout for at least 25 consecutive years. That's not a coincidence or a lucky streak. It's a demonstrated, decades-long commitment to rewarding shareholders through good economic times and bad. When a company has raised its dividend every single year for a quarter century, it tells you something real about how that business is run. Third, high-yield dividend stocks. These pay a larger percentage of their share price back to investors as dividends, which accelerates the snowball early on by generating more cash to reinvest sooner. They typically carry more risk than blue chips or aristocrats, which is exactly why Mike doesn't rely on these alone. They're an accelerator, not the foundation. And fourth, growth-oriented dividend stocks. These are companies that pay a smaller dividend today, but are growing quickly, meaning that dividend has real potential to increase substantially over time. They add long-term upside to the portfolio that pure high-yield or blue-chip stocks might not offer on their own. By requiring at least 3 of these 4 boxes checked, Mike filters out stocks that might look tempting on the surface but don't actually support a long-term snowball strategy. Using this exact criteria, here's the kind of portfolio Mike builds for his $12 a week. He spreads his weekly contribution across a small handful of dividend-paying stocks and one broad dividend-focused ETF, chosen specifically because they check multiple boxes from that four-category list. Individually, none of these picks are flashy. One offers a modest yield around 2 to 3%, but has a track record of double-digit annual dividend growth. Another is a dividend aristocrat with over 2 decades of consecutive increases and steady, if unspectacular, share price appreciation. A third leans higher yield to accelerate early reinvestment. Blended together, this portfolio gives Mike an average starting dividend yield in the low single digits, combined with a historical dividend growth rate that's compounded in the double digits annually, alongside modest but consistent share price appreciation over time. None of these numbers look impressive in isolation. Together, compounding for over a decade, they're what actually builds the $500,000 outcome. Alright, let's get into the actual math, because this is where the snowball effect becomes real. Mike starts with $12 a week. That works out to about $48 a month, or roughly $624 a year. On its own, that's a modest, unremarkable number. In year one, after contributions and modest early dividend reinvestment, Mike's account sits somewhere in the low four figures. It doesn't look like much. If Mike were to stop here and judge the strategy by year one alone, he'd probably conclude it's not worth the effort. By year three, Mike's total contributions have added up to a little under $2,000, and with dividends being reinvested along the way, his account balance has modestly outpaced his own contributions, a small but real sign the snowball is beginning to form. Even by year 7, something starts to shift. Mike's reinvested dividends have compounded enough that a meaningful portion of his account growth is no longer coming from his own $12 weekly contributions. It's coming from the dividends his existing shares are generating and reinvesting on their own. This is the inflection point most beginners never reach, because they quit somewhere in year 2 or 3 when progress still feels invisible. By year 15, Mike's portfolio has grown substantially, with total contributions still relatively modest compared to the overall account value, because the majority of the growth by this point is being driven by compounding dividend reinvestment and share price appreciation working together, not by new money going in. And by year 25 to 30, with consistent $12 weekly contributions maintained the entire time, and every single dividend reinvested without exception, Mike's portfolio reaches the full snowball effect, climbing to roughly $500,000 in total value. At that point, the annual dividend income alone, if Mike chose to stop reinvesting and start collecting it as cash, would represent a substantial 5-figure yearly income, translating into a meaningful monthly paycheck generated entirely from a strategy that started with spare change most people wouldn't think twice about. Let's put that in perspective. Over those 25 to 30 years, Mike's total out-of-pocket contributions from his $12 a week add up to somewhere in the $15,000 to $19,000 range total. The rest, the overwhelming majority of that $500,000, came from compounding dividend reinvestment and share price growth, not from Mike's own pocket. That's the entire point of the snowball method. Your money does exponentially more work than you do, but only if you give it enough time. Now, a quick and honest note on risk, because no beginner guide should skip this. Dividend payments aren't guaranteed. Companies can and sometimes do cut or suspend dividends during difficult periods. Share prices fluctuate, and past dividend growth rates aren't a promise of future performance. This strategy requires genuine patience across market ups and downs, and it works best when Mike keeps contributing consistently, especially during downturns, when share prices are lower and his $12 buys more. So here's the real takeaway from this entire video. You don't need a large starting sum. You don't need to pick the next hot stock. You don't even need much financial knowledge beyond understanding these 4 criteria and the discipline to reinvest every single dividend without exception. What you need is $12 a week, a properly diversified selection of dividend-paying stocks that check the right boxes, and enough patience to survive the boring years before the snowball effect fully takes over. That's genuinely the whole strategy. It's complicated. It's just slow at the start, and then, eventually, it isn't. If you want to see how Mike could reach this same $500,000 goal even faster by slightly increasing his weekly contribution, click the video on your screen. I break down exactly how much faster a small increase actually makes.